Hi there, welcome back to Dukascopy TV. I'm Ben Jones. The all-important US inflation rate has just been released, and joining me on the line to analyse it is Peter Warburton from Economic Perspectives. So Peter, the core inflation rate has reached 1.8% and CPI has come out at 2%, which is in line with the Federal Reserve's target. Were you expecting a figure like this, and what does it reveal about the US economy?
The rise in the core rate to 1.8% was, I think that was widely expected. I think the headline rate was probably a little bit higher than the market thought. And indeed, I think that was direction of my bias certainly would be to higher after the producer price inflation figures that we just had. Just as a reminder that there was a 0.6% rise in the producer price figures for April, and that carried it to 2.1% as well. But that's moved up very smartly, and a picture is emerging here of a strengthening American economy, which is putting more pressure on. We've seen production workers' wage inflation rising. We've seen consumer import prices rising again, having been falling in the past year. And just basically a general reversal of some of the positive influences that held inflation down. So I think probably we say that last October was the weakest point of the inflation cycle, if you want to call it that. And actually we're now moving up really quite smartly, aided by some of the post-winter normalisation and tightening of the American economy.
Now, the labour market is continuing to improve as well. Jobless claims have fallen to their lowest in 7 years. So with strong inflation and jobless claims data, does this demonstrate that the Fed's current monetary policy is working?
Well, it's working in the sense that it is, still creating positive momentum in the labour market, and indeed in many industrial markets as well. But I think there has been for some time now an element of irresponsibility about the way in which policy has been framed. So basically what we're saying is that we have this amorphous concept of labour market slack, which is very much at the heart of Janet Yellen's speeches and thinking, which can be defined and redefined, to suit whatever current purpose the Fed has. But what it means is that whilst the perception of inflation as a threat is very weak, then were you to pursue an even lower unemployment rate against the backdrop of warming both US and global economic activity, you could very quickly find that inflation was rising much more rapidly than you expected, much more rapidly than the Fed's own models expect. So I would say that policy is credibly irresponsible, but it is still irresponsible.
And finally, Fitch Ratings have recently stated that the US is on its own now, outlining that monetary stimulus will not be the key driver for the US economy. The report states that consumer confidence will increase and boost equity markets and strengthen the housing market. Do you agree with this?
Yes, up to a point. I mean, I think 2014 and 2015 always had the promise of being strong growth years for America. So basically, the normalization of housing, the transformation of the energy balance with the rise of US oil and gas production really being quite sharp and dramatic, and eventually the recovery of business equipment spending and the improvement of consumer confidence as well. So that part I can accept, but I think I don't know that this is sufficient to say that we are on a higher growth trajectory. having shaken off the crisis. I think that is, we require much more evidence to prove that. So my conclusion would really be that that the US is on its own. It doesn't need the support of additional Fed purchases of Treasury bonds and mortgage-backed securities at the moment. But I think the vulnerability to relapse and crisis has not entirely gone away. So we can't rule out the Fed having to come back in some other way, should things go wrong, and should indeed, financial markets have another spasm.
Peter, thank you very much for joining me again. That's all from me for today. Thanks for watching, and make sure you join us tomorrow for the final day of the trading week. Goodbye.